I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. I think our year-end target is probably low, because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
While the market drifts through the low liquidity dog days of August, consolidating recent gains and plagued by stubborn institutional caution, FundStrat's Tom Lee is highlighting a powerful, non-obvious signal for a major rally. He argues that beneath the surface of this wait-and-see environment, the conditions are primed for a significant upward move. But the core of his conviction doesn't come from traditional metrics alone. Instead, Lee is pointing directly to the cryptocurrency market as his most reliable leading indicator. His entire near-term bullish thesis is anchored on one critical data point: Bitcoin's price action, which he argues has already fired the starting gun for a breakaway move in risk assets that the rest of the market has yet to price in.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, FundStrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved, and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up. Really, at the core, any fundamental investor is going to use valuation as really one of their anchors. Is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples will continue drifting higher. I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the in the U.S. stock market. There's not even 5,000 listed stocks anymore. I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years, but it's a blue chip company. They are the biggest compliant issuer of stablecoins in the U.S. and it's growing prodigiously. So in a way, it makes sense that it went from a $20 IPO to 200 today, because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity, because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's sitting on the sidelines. There's $7 trillion cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market. I think when people cite these numbers, and I've also heard Max Myers say that like 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay.
Well, I think there's consumer preferences could be shifting. Because you remember, post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change, and that's why you're seeing some of these. I don't think consumers are over-levered. To me, that's the sign of a peak in consumers because they can't amplify their spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID level. I think that, of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge. I think our year-end target is probably low because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
The foundation for Lee's bullishness is the proven resilience of the real economy. He notes that corporate earnings have successfully navigated 6 major stress tests in 5 years, from COVID to the fastest Fed hiking cycle in history, emerging stronger and justifying a structural re-rating to higher valuations. This fundamental strength is colliding with a powerful dynamic of asset scarcity. Lee points to a shrinking number of public companies and explicitly uses the blockbuster IPO of Circle, the compliant issuer of a major stablecoin, as the quintessential example of this theme. A scarce blue-chip company tied directly to the crypto economy commands an immense premium. Lee believes this dynamic, supercharged by trillions in cash sitting on the sidelines, has created a coiled spring, and Bitcoin's recent move is the first sign it's about to be released.
I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think a breakaway upside move in the S&P is coming.
All right.
Yeah.
That's your call?
I would say that's our base case, yes.
Starts next week.
I mean, I can't give you the hour and the day.
You said it might start next week.
But that's 5 days.
You want to put yourself out there by all means.
Yeah, but I think it starts within the next week, yes.
Okay.
I mean, really, since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are. But we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the UMich surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst because if we think there's cuts in the fall, that's good for stock.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So is the case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now, we haven't really seen a peak of a cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and dear Ito, as I quietly say, small caps. But then we should think of it in sort of second order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating, and now the stacked earnings 2Q versus 2Q is over 12%. That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.
Well, depending on the impact of tariffs.
Correct. And tariffs are things that are well telegraphed and socialized. And as soon as markets view it as one time, we will actually look through those. Let's keep in mind, tariffs are going to create winners and losers because the companies imports are 10% of our economy, and the companies that are highly reliant on imports are going to have effects that they have to reprice their business and margins. But if someone said that should take down S&P earnings and the S&P 500, they're overlooking that the S&P is a broad set of companies.
Ultimately, Lee's analysis elevates Bitcoin from a simple asset class to a premier macroeconomic forecasting tool. His bold call for the S&P 500 to surge to new highs this very month is not a guess. It is a direct conclusion drawn from a clear historical pattern. He states definitively that for the last 5 years, Bitcoin has led the S&P by approximately 1 month. Therefore, Bitcoin's breakaway move on July 9th is, in his view, the most important forward-looking data point in the market today. This transforms his entire outlook from mere speculation into a data-driven thesis where crypto is not just a participant, but the bellwether for global risk appetite. For serious investors, the key takeaway is that the leader of the digital asset world is now providing the critical signals for the traditional one.